Sunland Fiber Company is the creator of WIGO, a technology that weaves silver into its fabrics to kill bacteria and odor on clothing while managing heat. WIGO has become very popular in undergarments for sports activities. Operating at capacity, the company can produce 1,099,000 undergarments a year. And then we've got information here on the per unit and total cost for an individual garment when the company operates at full capacity. Okay? Now, let's read this next paragraph. The U.S. Army has approached Sunland Fiber and expressed an interest in purchasing 250,200 WIGO undergarments for soldiers in extremely warm climates. The Army would pay the unit cost for direct material, direct labor, and variable manufacturing overhead costs. In addition, the Army has agreed to pay an additional $1 per undergarment to cover all other costs and provide a profit. Presently, Sunland Fiber is operating at 70% capacity and does not have any other potential buyers. If Sunland Fiber accepts the Army's offer, it won't incur any variable selling expenses related to this order. So we're asked to prepare an incremental analysis to determine whether we should accept this offer or not. Okay, now let's go over the solution, but let's go over it step by step. The approach you need to take on a incremental analysis type of situation like this is to evaluate the incremental cash flows. And what that means is you need to ask yourself, what changes for one option versus another option? So, first we look at what changes if we reject the order. Absolutely nothing. Business exists as it was planned on occurring. So there's no incremental revenues of or cost of any kind. Now, accepting the order definitely has some impacts on incremental cash inflows and cash outflows. Okay, so we've got to go through the math there. Let me bring that over and show you how we came up with that. First, we'll explore the 1,125,900. And if I slide this over, you can see right here that if we take 210 times 42 cents plus 98 and $1, right? It gave us the 210 of direct materials, the 42 cents of direct labor, and the 98 cents of variable manufacturing, and $1 profit. And we multiply that times the quantity of the offer, we can calculate the revenues. That's where the 1,125,900 comes in. Okay? Now, Sunland should accept the offer since it's expected to increase net income by $250,000, and that's, the incremental cash inflow that we'll get from accepting the offer versus rejecting it. All right, you might want to look at some other costs involved, like where did we come up with these other costs, and you can look at it right here. 524,420, subtracting out the 105 and the 245 gets us to the 250,000. Okay, so we've got to figure out what those incremental costs are of accepting the offer, and all the detail is provided here times the number of offers. And remember, what we're doing is we're taking the incremental revenue minus the incremental direct material minus the incremental direct labor minus the incremental variable overhead to figure out what our incremental net income would be.